Welcome to Chapter 4 of Derivative Securities. My name is Kirby Arcundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. I'm currently working as a portfolio analyst and retirement strategist and an adjunct professor of accounting and financial management. This is Chapter 4 on interest rates from the excellent text by John Hall, Options, Futures, and Other Derivatives, 10th edition. We will study multiple different types of interest rates throughout this chapter. Some of those we will look at include the Treasury rate. Treasury bills are short-term debt instruments issued by the United States government. There are also Treasury notes, which are longer term. Generally, bills are considered up to 1 year. Notes are considered 1 year to 10 years, and bonds are up to 10 years. There is the LIBOR rate, or the London Interbank Offer Rate, which is a loan rate between European banks and is commonly considered the cost of capital for banks. There is the Federal Funds Lending Rate, which is an overnight lending rate, which is basically controlled by the United States Federal Reserve System. And there is the Repo Rate, which is also an overnight lending rate, but is securitized generally by selling and buying back an instrument like a Treasury bill. The Treasury rate is the rate on instrument issued by a government in its own currency. So in the United States, this would again be T-bills, T-notes, and T-bonds. These rates vary significantly from country to country and time period to time period, and are determined by things like Federal Reserve activity and inflation. Here is a Treasury yield curve in the United States. So we have the Treasury yield as a function of time, and we show it for 3 different time periods: December of 2019, December of 2020, and current rate, which is in December of 2021. So at our oldest time period, December of 2019, short-term debt of 1 month was at 1.5%, increasing up to 2.5% for the 30-year bond. Since then, we have had significant activity by the Federal Reserve, and the Federal Reserve, through activity of the Fed funds rate, can lower the short-term interest rate. They do this by printing money and buying short-term Treasury debt, therefore driving it down. And traditionally, since World War II, this was the primary activity setting the Fed funds rate of monetary policy by the U.S. Central Bank. In the last few decades, they have also been influencing long-term rates through what they call quantitative easing, where they also print money and buy long-term debt. In all 3 of these cases, we largely have a so-called upward sloping yield curve, where the interest rates on long-term debt are higher than short-term debt. This is consistent with what's called liquidity preference theory, where people are more likely to buy short-term debt since they will get their money back quicker than long-term debt since it is more risky. Having an upward sloping yield curve like this is important for banking institutions since they tend to borrow short-term and lend long-term, and therefore they will only make a profit if the long-term rates are higher than the short-term rates. The next interest rate we will look at is the LIBOR rate, our London Interbank Offer Rate. There's also a LIBID, a London Interbank Bid Rate. LIBOR is the rate of interest at which a AA bank can borrow money on an unsecured basis for another bank, and it's currently calculated for 5 currencies and 7 different maturities: 3 months, 6 months, etc. There have been some suggestions in recent years that banks have been manipulating or incorrectly reporting LIBOR. They do have an incentive to do this since a lot of their profits are based on things like swaps, and swap values are strongly influenced by LIBOR. LIBOR is being phased out at the end of 2021, and market participants are being encouraged to transition to a different rate, a risk-free interest rate. Here is a graph of LIBOR rates in Europe, London Interbank Offer Rate in US dollars lent in Europe. And we have a 1-month LIBOR, a 3-month LIBOR, a 6-month LIBOR, and a 12-month LIBOR. They have gradually tended down, just as interest rates throughout the world have tended down, particularly in dollars, and are now basically close to zero. Whereas if you go back into the 1990s and before that, we could have had LIBOR up around 11%. And these different maturities don't make a whole lot of difference, but in general, you would expect, as is more obvious here, that longer-term rates, 12-month LIBOR, would be higher than 6-month, which would be higher than 3-month, which would be higher than 1-month LIBOR. The next interest rate is the United States Fed funds rate. It's an unsecured interbank overnight rate of interest, and it allows banks to adjust the cash reserves on deposit with the Federal Reserve. This is the primary tool, historically, that the central bank, the Federal Reserve, has used to influence monetary policy and economic conditions in the United States. They can make the Fed funds rate go down by creating money and buying short-term U.S. denominated debt, or they can make it go up by basically destroying money, and they would destroy money by taking their U.S. debt on their books and then selling it for dollars, and then the dollars are basically, in a sense, destroyed by the Federal Reserve System. Here is a list of inflation and the effective Fed funds rate from essentially the beginning of its usage in the 50s until today. And you can see that what has been attempted is to raise the Fed funds rate to fight inflation, at least in the 70s and 80s. The U.S. government printed a lot of money in the 60s to finance things like Lyndon Baines Johnson Great Society program and the Vietnam War, which tended to make inflation go up, and then they were forced to default on the gold standard in the early 70s under the Nixon administration, resulting in reasonably high inflation, which was fought throughout the 70s, and eventually Paul Volcker, appointed to the Federal Reserve in 1979, drastically increased the Fed funds rate, shown here up above 20%, pushing the U.S. economy into what at that point in time was the severest recession since the Great Depression. To get inflation under control, he was successful in that, but of course inflation may be returning today as the Fed has lowered interest rates and doesn't seem to be nearly as concerned about inflation as it was historically. Of course, one of the reasons the government can't really fight inflation that easily is it has so much debt on its books. If it raises interest rates, it's raising interest rates on itself. Another rate, the repo rate. It's a repurchase agreement, repo. It's an agreement where a financial institution that owns securities agrees to sell them for X and buy them in the future, usually the next day, for a slightly higher price Y. So this is a loan, but it's a securitized loan because, of course, the bank, if they don't buy them back the next day, the creator of the repo can keep the security, usually a T-bill. So the rate of interest is calculated from the difference between X and Y, known as the repo rate, a secured short-term or overnight lending rate. Here is a graph from 2005 until 2020 or so, showing the overnight U.S. repo rate versus 3-month LIBOR. Again, the overnight rate is slightly less risky than LIBOR. The repo rate is A, secured, and B, shorter term, so you would expect the repo rate to be less than LIBOR, and most of the time it is. And occasionally, as we see during the housing crisis around 2008, is drastically different as LIBOR popped up here when there was significant worry about whether or not banks would stay solvent. The repo system is of course used in more countries than the United States and more debt instruments other than short-term T-bills. Here is the China 7-day reverse repo rate from around 2014 to around 2021, where it's ranged from a high of around 4.5% to between 2 and 2.5% today. Here's another example of repo rate, in this case in India, ranging from February of 2019 to August 2020, where it went down from around 6.25 to 4%. The most common type of swap is a fixed for floating interest rate swap, or in most cases, a LIBOR swap. So this is a swap where LIBOR is exchanged for a fixed rate. We will discuss it in detail in Chapter 7 and also in other videos. The swap rate where the 3-month LIBOR is exchanged for a fixed rate has the same risk as a series of continuously refreshed 3-month loans to a AA rated bank. This kind of swap is typically used by banks to manage their long-term fixed rate interest risk. For example, if a bank makes a 30-year home loan, they're taking on quite a bit of risk. If interest rates go up, the value of that home loan could drop significantly, doing damage to their balance sheet. This is, for example, what caused the savings and loan fiasco in the United States in the 1990s, which we will discuss in other videos. Another type of interest rate is the OIS rate, or the overnight index swap rate. An overnight indexed swap is a swap where a fixed rate for a period, e.g. 3 months, is exchanged for the geometric average of overnight rates. For a swap maturity of up to 1 year, there's a single exchange of payments at the end of the year. For maturities beyond 1 year, there are periodic exchanges, perhaps every quarter, and the OIS rate is a continuously refreshed overnight rate. Here is a graph from 2005 to 2010 showing the time period of the housing crisis, and it is a graph of the spread between the interest rate swap rate and the overnight index swap rate for US dollars, Japanese yen, and the euro. You can see that during the time period of the housing crisis, this spread increased drastically, again due to worry about solvency of banks, and it increased the most in the US dollar, up to around 170 basis points, an intermediate amount in the euro, up to around 100 basis points, and not nearly as much, maybe 60, 70 basis points for the Japanese yen. The risk-free rate should be the compensation for an individual for deferring gratification, i.e. buying tomorrow instead of buying today. Historically and in textbooks, the U.S. Treasury rate was considered to be a risk-free rate. It really isn't considered that today. It's artificially low and in fact well below the inflation rate. There are multiple reasons for this. One, banks are not required to keep capital for Treasury instruments. Two, the Treasury instruments are given favorable tax treatments. But the most important one is, of course, the U.S. Central Bank, the Federal Reserve System, intervening and keeping Treasury bill rates artificially low to, quote, stimulate the economy, and also to cut down on the rate of interest that the United States government has to pay on its debt. For these reasons, the OIS rates are now considered as a proxy for risk-free rates in derivatives valuation. For real risk-free rates, they are also probably too low. We will now discuss the impact of compounding, or how different compounding periods influence future rates. This will be gone into more detail in another video using Excel, but we consider, for starters, the value of $100 at the end of 1 year at a 10% compounding rate. Well, the future value of this is just going to be the 100, the present value A, times 1 plus the interest rate divided by the number of compounding periods to the number of compounding periods. So if compounding only occurs once a year, you have 100 times 1.1 are 110. If it's 2 times a year, then during the first 6 months, you're going to have 100 times 1.05 are $105 times 1.05, which gives you 110, but now you get an extra quarter, 25 cents, due to the interest on the interest in the second 6-month time period. As we increase compounding, we increase the interest on the interest, and therefore our future value goes up, but only slightly. The compounding frequency used in an interest rate is the unit of measurement. The difference between quarterly and annual compounding is analogous to the difference between miles and kilometers, meaning if we know the present value of an investment and the future value of an investment, how we quote the interest rate can be done in multiple different ways. If we get the same amount at the end, we can quote it continuously, we can quote it quarterly, we can quote it daily, and it's basically just a different language of how you do so. Now, of course, being able to quote it in all these different ways can be confusing, which is why these sort of quotes are commonly converted to one type of rate, either a continuous rate or an equivalent annual rate. For derivatives classes, generally continuous compounding is the most common rate that is used. It makes the math simpler, and continuous compounding is the limit when we compound more and more often, 1,000 times a year, 10,000 times a year, 100,000 times a year. And as we do this, which will be shown again in another video, you can show that the Taylor series turns into the future value as the present value, for example, 100 times the exponent e to the RT, where the exponent is 2.71828. So if we want to discount it and find the present value as opposed to the future value, then we would have the present value as our 100, or our future value, times e to the minus RT. Again, this will be explored more in another video. Converting back and forth, as shown in the other videos, we can solve for R continuous as a function of R quantized. So R continuous is M, the number of compounding periods, times the natural log of 1 plus Rm over M. So if M is 1, Rm is the rate quoted once a year. If M is 2, R2 is the rate quoted twice a year, and you're converting that to the equivalent continuous rate. That will give you the same future value as a function of present value at the end of the year. You can reverse this formula and say Rm equals M exponent of R continuous divided by M minus 1. And again, this is the equivalent of converting from meters to miles, some type of unit system to another type of unit system. Examples, 10% with semi-annual compounding is equivalent to 2 times the natural log of 1.05, or 9.758. The continuous compounding number will be larger than the quantized compounding number, and as this number approaches infinity, 2, 4, 10, 1,000, then this number will approach 10. How about 8% with continuous compounding is the equivalent to 4 times e to the 0.08 divided by 4 minus 1, or 8.08. And again, as this number approaches infinity, now this number will get smaller until it approaches 8. And whenever you do option pricing, you generally use continuous compounding because it's a lot easier mathematically. Look at one of my other videos to show these calculations in more detail than Excel. How about zero rates? Zero rates are spot rates for maturity T is the rate of interest earned on an investment that provides a payoff only at time T, are basically a zero coupon bond, and we will be using these for the concept of bootstrapping. First, we will show if we have the zero rates, how to use them to get the price of a bond knowing the coupon payments, and then later off, we will demonstrate using the bootstrap method how to get the zero rates. So let's say we have a table here of zero rates. A bond maturing in 6 months has a zero rate of 5% if it was a zero coupon bond. A zero coupon bond maturing in 1 year, 5.8. A zero coupon bond maturing in 1.5 years, 6.4%, and a zero coupon bond maturing in 2 years with a zero rate of 6.8%. We could then calculate the cash price of a bond using the appropriate zero rates. For our example, we will consider a 6% coupon bond that pays interest twice a year, semi-annually, and matures in 2 years. So we get a $3 payment in 6 months, another one in a year, another one in 1.5 years, and then at the maturity of the bond, we get $3 plus the face value of $100. We showed earlier that the zero rate was 5% for 6 months, so we discount the first coupon by e to the minus 0.05 times 0.5. The second zero rate for expiration in 1 year is 5.8%. So we take 3 times e to the minus 0.058 times 1, since that's in a year. Then 3 e to the minus 0.064 for the zero rate in 1.5 years. And the final zero rate of 6.8%, so we take 103 e to the minus 0.068 for a payment in 2 years. Running through this through Excel or your financial calculator, you get $98.39. This would mean that the average zero rate, or the yield overall on the bond, is going to be higher than 6%, and therefore our bond is trading at a discount. If we wanted to get that actual yield, well, the bond yield will be the overall rate of return for the life of the bond. So for the zero rates, each of these are different. For the life of the bond, the total yield is going to be the same Y throughout them. And we will solve this either using Excel or a financial calculator. So again, we have 2 years worth of payments every 6 months, 3, 3, 3, and 103. Each of these payments is discounted by the time period which it takes place, 1/2 year, 1 year, 1.5 years, and 2 years. And the current price of our bond is $98.39. So you can either use this as a financial calculator problem and get the 6-month rate and then use the formula derived earlier to convert that to a continuous rate, or you can do the same thing in Excel using the rate formula, and we show how you do this in a separate video, and we end up with a yield of 6.76%. Again, that has to be above the 6% yield because our bond is trading at a discount. If this was exactly 6%, this would be 100, and if this was less than 6%, this would be greater than 100. If we want to figure out the par yield, well, we can derive a formula for that. So the par yield would be the coupon payment that is going to be necessary for us to get a price of the bond at 100 or at par. Well, our coupon is on a semi-annual basis, so you take the annual coupon, divide by 2, and you can take each of these payments again to the zero rate, either minus 0.05 times 0.5, and the next one, 0.085 times 1, 0.064 times 1.5, and then 100 times the coupon divided by 2 of e to the minus 0.0682. This is a reasonably simple algebraic problem to solve. You can pull out the c and then sum this term, this term, this term, and this term. And then from that, we can subtract off the 100 e to the minus 0.08 times 2 from this 100 divide and solve for C, and we get 6.87. We can derive a more general formula for the par yield, which we will show in a separate Excel video, and we get this formula C for the par yield, where D is the present value of $1 received at maturity, so this will be finding the present value of this $100 bullet payment. M is, in this case, 2, the number of coupon payments per year, and A is the present value of an annuity of $1 on each coupon date. So for our example, M was 2, D can be shown to be 0.87, and A can be shown to be 3.7, and again you will get as C the coupon stated above, which was 6.87. How do you determine a zero curve? We will go through this briefly here and again in more detail in a separate Excel video. Let's say we look at various bonds, 1, 2, 3, 4, 5 of them, with a bond principal of 100, and these prices for a bond maturing in 3 months of 99.6, 1 in 6 months of 99, 1 in a year of 97.8, and all of these are zero coupon bonds, so you can just use these numbers, use the zero coupon bond formula, and solve for the zero rate. But then it gets more complicated for the last 2 bonds here. This one pays a semi-annual coupon of $4 or 2 every 6 months. This one pays a semi-annual coupon of $5 or $2.50 every 6 months. And both of these bonds are trading at a premium, which means interest rates have dropped since they are issued. So for our first 3 bonds, we can use the simple zero coupon bond formula. For the last 2, we would have to use the bootstrap method. So we can start by looking at our first bond maturing in 3 months. It's going to earn $0.440 on its $99.6 principal. And what we want to solve for is the interest rate here. How we would get that is we take the 100 divided by 99.6, take the natural log of that, and divide by 0.25. That gives us the zero rate as 1.603. And again, look at a separate video on the bootstrap method to show this in more detail. And you can do the same approach for the 6-month and 1-year bonds, just using the simple present value equals future value e to the minus RT formula. But if we proceed beyond those bonds that do not pay a coupon, we have to get a more complex formula. So we will look at the bond that matures in 1.5 years. It pays $4 a year, or $2 every 6 months, and a final bullet payment of $102. From calculating these zero rates for the bond expiring in 6 months and the one expiring in a year, we get these 2 numbers. And then our mission using the bootstrap method is to solve for this term R for our 1.5-year maturing bond, which is trading at $102.50. So what we will do is we will calculate this number, we will calculate this number, we will subtract them both from here, we will divide by 102, we will take the natural log and divide by minus 1.5 and get 0.02284 or 2.284%. For this bond, we had 3 components because it was a 1.5-year bond, and we knew 2 interest rates. For the 2-year bond, we will then know 1, 2, 3 interest rates, and we will use the same method to solve for the 4th interest rate of 2.416%. Again, look at the Excel video to show these calculations in more detail. From that bootstrap method, again using the zero coupon bonds, we can calculate the zero rates up to 1 year. And then with the coupon-bearing bonds, using the knowledge we gained earlier, we can calculate the interest rates at 1.5 years, 2 years, etc., and get a standard curve, which, like this one, is at least largely upward sloping yield curve. The overnight index swap rates used out to 1 year are zero rates. Beyond that, the overnight index swap rates will be par yields. The next interest rate type is forward rates. The forward rate is the future zero rate implied by today's term structure of interest rates, at least if you use the pure expectations theory of the term structure. Suppose that zero rates for the time periods T1 and T2 are R1 and R2, with both rates continuously compounded. The forward rate for the period between times T1 and T2 will be R2 T2 minus R1 T1 over the difference between T2 and T1. This equation is derived in a separate Excel video that will show the calculations. Let's consider how to calculate forward rates looking at this example of an upward sloping yield curve. So we have years 1, 2, 3, 4, and 5. Zero rates, like calculated from zero coupon bonds, going upward from 3, 4, 4.6, 5, and 5.5. And then we were wondering, how would you calculate the forward rates? Since it's an upward sloping yield curve, if we consider the pure expectations theory, then we would say that under pure expectations theory, it doesn't matter how long I lock my money up, whether I lock it up for 2 years or whether I lock it up for 1 year, get it back, and then lock it up for another year, I could get the same total rate of return, and that is how you calculate forward rates. So for example, future value would equal present value e to the 4 times 2, and that should get you the same rate as present value times e to the 3 times e to the whatever the forward rate is. If you solve for that forward rate, you will see it as 5. So for an upward sloping yield curve, the forward rates will always be higher than the zero rates. And again, this is derived in more detail in a separate video using Excel. It is possible to look at so-called instantaneous forward rates. The instantaneous forward rate for maturity of time t would be the forward rate that's applied for a very short time period starting at time t, and you would get that by saying it's R is the interest rate in the tth year or moment, 1.3 years, whatever, plus whatever that t is, times the partial derivative of R with respect to the t, or the slope at that particular point on the yield curve. As we showed for an upward sloping yield curve, forward rates are above zero rates. We could also say they are above par rates. For a downward sloping yield curve, we have a par yield above the zero rate, which is above the forward rate, exactly the opposite of for an upward sloping yield curve. Forward rate agreements, and the sum of them, which will be swaps, which we will study later, and a forward rate agreement is an over-the-counter agreement that a certain rate will apply to a certain principal during a certain future time period. It is a mechanism for companies to lock in interest rates sometime in the future. We can look at an example of a forward rate agreement. A forward rate agreement is equivalent to an agreement where interest at a predetermined rate, RK, is exchanged for interest at the market rate. So the RK is set, the market rate at the time the agreement is signed is unknown. And FRA can be valued by assuming that the forward LIBOR interest rate, RF, is certain to be realized. This means that the value of a forward rate agreement is the present value of the difference between the interest rate that would be paid on the agreement RF and the interest that would be paid at RK. If the period to which the FRA applies lasts from T1 to T2, we can assume that RF and RK are expressed with compounding frequency corresponding to the length of the period T1 and T2. With an interest rate of RK, The interest cash flow would be RK times the difference between T2 and T1. With interest RF, then the cash flow would be RF times T2 minus T1, times, of course, whatever the principal is. So when the rate RK will be received on a principal of L, the value of the forward rate agreement would be the present value of L times the difference between the RK and RF for the time period T2 minus T1. If RK is to be paid in the forward rate agreement, then you merely take a negative sign of this and you end up with RF minus RK. As a mathematical example, we can have an FRA entered into some time ago ensures that a company will receive 4% semi-annual on $100 million for 6 months starting in 1 year. Forward LIBOR for the period is 5%. The 1.5-year risk-free rate is 4.5% with continuous compounding. So the value of the FRA is going to be the $100 million times the difference between the LIBOR rate and the rate at which the agreement was made, 4%, times 1/2 times its semi-annual. This payment takes place in 1.5 years, so you discount at the risk-free rate of 4.5%, and you get negative $0.467 million, the current value of the forward rate agreement. And of course, it's going to be negative for one side of the FRA and positive for the other side of the FRA. If the 6-month LIBOR interest rate in 1 year turns out to be 5.5% instead of the previously quoted interest rate, again semi-annually, there will be a payoff in millions of dollars instead of $100 million times the difference of 0.04, the contract rate, minus 0.055, the LIBOR rate, times again 0.5 for 6 months, are negative $0.75 million in 1.5 years. And of course, the transaction could be settled at the 1-year point for the present value of this amount. The next very important concept when dealing with bonds is duration. Duration of a bond that provides cash flow CI at time t is shown here. What does this mean? So the duration of the bond is the summation of the time when a cash flow takes place times the present value of that individual cash flows divided by the price of the bond, which is the present value of all of the cash flows. So this is the fractional present value of a given cash flow times the time which it takes place. So this is basically a measurement of how long it takes you to get your money back. If we want to know an approximation for the change in value of a bond, delta B divided by B, well, that's the minus duration times a change in interest rates. This is assuming a parallel shift in the yield curve. So duration can be used to manage risk. For example, banks try to match the duration to some extent of their assets and liabilities to limit interest rate risk from interest rates going up and destroying the value of their assets. When the yield y is expressed with compounding at n times per year, we can say that delta B, the change in the bond's price, is negative the bond's price times the duration, change in the interest rate over 1 plus y over m. This term is sometimes called the modified duration, and it's one of the reasons it's easier to deal with continuous compounding, because as m goes to infinity, well, this term goes away and the modified duration is the same as the regular duration. If we want to look at the duration of a bond portfolio, or for a bank, a mortgage portfolio, then the duration of the bond portfolio is the weighted average duration of the bonds in the portfolio with weights proportional to prices or total dollar amounts invested. The key duration relationship for a bond portfolio describes the effect of small parallel shifts in the yield curve. So as mentioned, it is a common technique to limit risk to try and max the duration of your assets and liabilities Well, what exposures remain if duration of a portfolio of assets equals the duration of a portfolio of liabilities? Well, one that remains is the convexity. Another risk that would remain would that be resulting from a non-parallel shift in the yield curve. The convexity of a bond is defined as this term. It is the second term in a Taylor series if you expand the value of a bond in terms of interest rate changes. So the first two terms in a Taylor series for change in a bond's price over the bond's price minus the duration times a shift in yield curves plus 1/2 times the convexity times the change in interest rates squared. That convexity is 1 over the price of the bond, the second derivative of the bond's price with respect to interest rates squared, which is 1 over the price of the bond, the summation of the coupon payment of the bond, present value thereof, now times that time squared. When used for bond portfolios, this allows for larger shifts in the yield curve to be considered, but the shifts still have to be parallel or this relationship won't work. Again, we will do calculations related to this concept in a separate Excel-based video. There are three theories of the term structure of interest rates. The expectation theory is that forward rates equal expected future zero rates, and you would only have an upward sloping yield curve if you expect interest rates to go up, or a downward sloping yield curve if you expect interest rates to go down. The so-called pure expectations theory is what we have used to derive forward rates. Nobody really believes this is completely true, but it does explain phenomena like the inverted yield curve when Paul Volcker massively increased short-term interest rates to get inflation under control around 1980. A second theory of the term structure is the market segmentation theory. The idea behind this is short, medium, and long-term rates are determined independently of each other, that there is a different market for each. This commonly explains the fact that very long-term rates around 30 years are slightly lower than maybe 29 or 28-year rates. So a normal yield curve is upward sloping, but there is a demand for 30-year very long-term bonds by organizations like insurance companies and pension funds that have very long-term liabilities and want to match those assets. The simplest theory is liquidity preference, and forward rates should be higher than short-term rates because people would prefer to be able to go to a bank and just get their money out, and they're not willing to lock up the money unless they get a higher interest rate. So, of course, all three of these theories are combined together to usually explain what a yield curve looks like. Here is an example of a way of thinking about the liquidity preference theory. Suppose that the outlook for rates is flat and you have been offered the following choices. A 1-year and a 5-year deposit of 3% and a 1-year and a 5-year mortgage of 6%. Well, if you're a depositor, you're going to want to be able to get your money back whenever you can, so you're going to go with the 3%. But if you're a borrower, then you're going to want to limit your risk as long as possible, and at least if you can pay off your mortgage early, which you legally can under U.S. mortgages, then you're going to go with the 6% rate. So the depositor wants the 3% rate, the borrower wants the 6% rate. To match the maturities of borrowers and lenders, a bank has to increase long rates above expected future short-term rates. So in our example, the bank might offer deposit rates of 3 and 4% and mortgage rates of 6 and 7%. I thank you for watching this video.